What's going on, everybody? It's Spencer from Gray Capital. And if you are a multifamily investor, real estate investor, you're thinking about getting into it, or maybe you're already in the multifamily industry and you're trying to stay up to date on the latest news, research, and information, well, you're in the right spot, because on the Gray Report, that's what we're doing every single week, breaking down latest research reports, articles, anything that's going on in the multifamily industry, real estate, and the economy that you need to know. I am out here in Orlando, Florida at the National Multifamily Housing Council's annual meeting. It's the biggest meeting of the top owners, brokers, lenders, everybody in the industry. If you're a real player, you are here. Looking forward to getting into that, as well as some great reports out from Marcus and Millichap, RealPage, RentCafe, and way more than that. Talking about inflation, outlook for 2022 and beyond. All right, Matt Bosnagel's here once again. Let's bring him in here. Let's get into it. All right, everybody. Again, I am in Orlando, Florida at the National Multifamily Housing Council, or the NMHC annual meeting. Matt Bosnagel joining us again, back in Indianapolis at the Gray Capital HQ. Matt, again, I appreciate you holding down the fort. How's everything going back in Indy?
It's going great. We're staying busy, and I like your. This is good reporting. You're live on the scene, so this is spectacular.
Live on the scene and just getting in the thick of it. And if you're not familiar with NMHC, it's the National Multifamily Housing Council. This is a trade group that represents apartment owners, lenders, really the entire industry. They're an advocacy group, so they're the ones that are lobbying Congress if there's any big legislation on the federal level that is really going to affect the multifamily industry. These are the advocates that are representing apartment owners, multifamily investors, and the like. They also do a lot of great research. They put together meetings, advisory committees, and again, there's so many people are here. Major players. We're talking, REITs. We're talking major private equity groups. All the lenders, all the top brokers. What I love about being here, besides, we're doing meeting after meeting after meeting, so you get to actually get in person with all these people that we work with remotely, or they work across the country. Everybody's getting the same spot. But Matt, what I find is just interesting, I know you would find this interesting too, is just the information that you overhear just walking down the halls. There's a type of energy. People are doing deals, talking about deals, getting deals done, comparing deals. And so, it's easy to get insulated in your market or in your group of, a couple lenders, maybe a lender, a broker or two. You kind of hear the same story. But here, people are, again, from all over the country, really all over the world, talking multifamily. And so we get a lot of really interesting perspectives. And after not being able to go last year's, it's great to be back. Great to be back in Orlando and see what is going on. So it's a lot of fun.
Yeah, that's interesting. We were talking about Zillow, how they couldn't handle all this data, and they made a wrong bet thinking they could predict the real estate market. It looks like the real nerve center is in people, and they're all in the same place right now. So that's particularly exciting.
Yeah, no, it's true. I mean, most businesses are people businesses, but especially real estate, it's so relationship driven. Whether that's the lenders, the brokers, investors, owners. So yeah, 100%. And it's exciting because, a lot of data is released here. Just a lot of predictions are being discussed. And so, I know that's what we're going to be talking about. So we talk about every week. But Matt, I texted you last night pretty late because I was so excited. I was a little tickled. I also felt like a big nerd, but I got to have dinner with John Chang from Marcus and Millichap, and I got to ride on a bus with Greg Willett, who formerly of RealPage just joined the Marcus and Millichap team. And both of these guys are like, they are one of the top researchers and experts when it comes to housing research. And so this is something we do every single week, Matt. We're following this. We're obviously interested in it. And to have these two guys that I'm reading their stuff, every week or every couple of weeks. Greg is really active on LinkedIn, puts out a lot of great insights. And, I'm happy to report, at least got some verbal commitments to come on the Gray Report here in the near future. So we can really tap into that wisdom, see what's going on, because these guys are just living encyclopedias for research and data, where the top markets are, which ones you want to watch out for. So really cool.
Now,
Excited to have him on.
Spencer, I do have a question. So you've kind of got your finger on the pulse right now. What are they saying? Are people thinking this is going to be another year of huge growth? Like, what's the feeling there? What is the big kind of danger that they're seeing? And then what are people really excited about?
No, that's a great question. I mean, the consensus is that the year is going to be incredibly competitive. A lot of acquisitions are on folks' radars. A lot of people are trying to buy deals, even more than in 2021. So the competitive landscape is really going to be more than ever. And what that does to price growth, I mean, we'll see price growth because of that. But in terms of fundamental growth, in terms of rents and vacancy, and even cap rate compression, most people think that will moderate significantly, just because, as we've been discussing and reporting on, Matt, we're going to see some return to normalcy. But also with raising interest rates, especially the 10-year Treasury moving up, the Federal Reserve set to do multiple rate hikes throughout 2022 and 2023. It's obviously raising the cost of borrowing. And so all of a sudden these, 3-cap deals that we've been hearing about that have penciled because folks are locking in sub 3% debt, those are going to be harder and harder to do. Now, a lot of groups are using very low leverage. So in terms of discussions of a bubble or things looking just way too frothy, on the surface, I think that it certainly appears that way. But surprisingly, most loans, even throughout 2021, they were relatively low leverage loans. I think the average LTV, at least in conversations with lenders today, throughout last year, it was in kind of the 60 to 65% range. So that's compared to typically closer to 70, 75%. So a lot of groups aren't using as much leverage, which means more equity in the deal. The projects are going to be a little bit safer.
Yeah.
Obviously, returns can lower, but everyone is expecting further rent growth, but we're not going to see the 10 to 30%, maybe in the 5 to 15% range, depending on where you are. But I know we're talking about inflation later today, Matt. And so a lot of these assumptions are based on kind of what we know now, and assuming that inflation really starts to kind of normalizing and decreasing. But there's also certainly concerns that there could be further price pressure, whether that's from wages or other inflationary impacts, which we've looked at, comparing rents to, other CPI metrics, and rents, still, if you look at the kind of compared to everything else, still have some room to go. So not a lot of negativity, which, certainly can be scary. You want to watch out when there's a consensus, everyone's sure that it is a, sure thing, that can certainly be a cause for concern.
Well, that's what I was wondering, if there was a streak of, one line of argument that maybe even if it's dismissed as quickly as it's brought up, is there a slight telling worry among these investors and sellers and buyers?
I think in some metros where there's, a lot of supply coming online, there's a little bit of concern. And then also just a realization, again, not really a concern of things aren't going the right way, but just yields have compressed so much and just returns are lower, especially in the Sun Belt. And so a lot of discussion of people going to the Midwest, looking for, really chasing return, chasing yields. And a lot of folks that, have really only been in the Sun Belt, they are looking elsewhere. So I think for some of the really secondary and tertiary markets, Midwestern markets, and also secondary, tertiary markets everywhere, but specifically the Midwest, it looks like we're going to see even more activity from, out of state investors, which, will drive down cap rates, prices up. And maybe that makes an opportunity elsewhere. But I think,
also could help people, if you get into one of these Midwest markets for everyone else, then you could see, values increase in the next 2 weeks or something.
Yeah, exactly. That's the thing. I think the story is a little bit out, and I'm not saying that people will be late, but they're not going to be early. That's for sure. So the fascinating research. I think we're going to have some actual research from NMHC, I think, on the show for next week. I haven't had time to kind of put all that together yet. But yeah, it's been a fascinating time. It's great to get together with people in person. But I will have to say, if you did not have COVID or Omicron before you were at this event, people are going to get it, because there's a lot of people. No one's wearing masks, including myself. And it's very close proximity. Now, there's also a lot of consensus that, okay, Omicron is essentially like a mild cold at this point. So there's not a ton of fear, but if there was ever a super spreader event, I'm sure this will be one.
A lot of warm bodies in the swampy Orlando, humid. Yeah,
exactly. Actually, the weather's not that bad. It's kind of perfect weather for having to wear a sport coat. But just on that fact, talking about Omicron, then I want to get into the research report so we have enough time. But the positive sign that a lot of people are talking about is that Omicron does get to the population, we get some semblance of herd immunity. We could be over with COVID sooner rather than later. And really 2022, most people are talking about this is going to be the last year of the pandemic. We're going to get back to normalcy, and that will allow economic growth to really take off.
That's great. Yeah.
Yeah.
I think that, and none of the reports that we're covering today outright said it, but the assumptions were like, okay, we're about done.
Yeah. Whether the virus is done or if we are done, we're almost done.
Yeah.
All right, Matt. What do we have on the report? I think we've got a great report from Marcus and Millichap. If that's up next, but let's get into the latest research.
The report on from Marcus and Millichap was really excellent, and it may have been one of my favorite pieces of research that I read from them. It goes through along with breakdowns for 46 of the top multifamily markets. They point to a similar set of national trends that we talked about in CoStar's report, although they kind of go into it in a little more depth even than the CoStar report did. It talks about the broader economic pressures, talks a little bit about the capital markets and things from the perspective of the apartment market, and really kind of gives a nice robust forecast for 2022. Just in brief, it mentions how higher wages could alleviate labor shortages and supply chain issues are expected to persist. Both of those really seem like ingredients for inflation.
Yeah.
And it's looking less likely that the Fed will be able to really solve the problem. They might, the Fed's actions could be maybe symbolic and they might lessen the effects. But I think it's overdetermined at this point that we're going to see some inflation. Really, the Marcus and Millichap's top line message on the apartment market itself is fairly similar to the forecasts from Yardi Matrix and CoStar. Multifamily is not going to have another banner year like 2021, but the fundamentals are projected to improve even further this year at a more typical pace. Demand is going to outpace supply, surpassing a record 400,000 units of construction to keep availability low across quality tiers. And some of those projects, and we've mentioned this before, some of the projects that are scheduled to complete in 2022 may end up being completed in 2023, depending on how the logistics chain is in supply and labor shortage and all that kind of mess, depending on how that resolves.
A lot of folks watching, the supply chain, when things, can really open up. And as we were talking about, once just this madness kind of subsides and we can really get back to normal, what the economy looks like at that point. Matt, can you get into a little bit on maybe on the migration to the suburbs versus people living downtown? There's been a lot of talk about the downtowns coming back. What's the take? What did John?
And this is exactly what you noted here. The migration to suburban areas is expected to continue as the pandemic wanes, and so I think our investors, they're kind of looking beyond these primary markets into secondary and tertiary markets as well. Things continue to more or less disperse, and as renters look for opportunities and their lifestyle changes, and as investors themselves look for higher yields. I think that on that side, on the investment side, this report expects to see a great deal of competition from assets. I've been reading some things about European investors looking to enter the American multifamily market. That's outside this report, but that's just to say that it's incredibly competitive. And this quote right here is really just sums it all up here. The search for yield amid an increasingly competitive bidding environment will compel investors to consider assets across a greater selection of markets. This corresponds with the demographic shift to secondary, tertiary cities. It's also benefiting apartment operations. So people are spreading out, and they're finding these opportunities that aren't necessarily big cities. Now, people will come back. They say elsewhere in the report that they're going to come back a little bit to the urban core. It's not going to be neglected, but there is these broader demographic shifts that look like things were moving towards the suburbs, even apart from the pandemic.
It's fascinating. Well, vacancy and rent growth in
Yes.
2022. Can you just take us through that real quick?
Yeah. So this is a good example of the story of different markets that we've kind of really noticed as the pandemic has progressed.
Yeah.
Some markets, have been hit really hard and been on the upswing. We talked about markets like New York last week, that the recovery is firmly in progress there. Some markets have been steady throughout. You can see this, this is like Midwestern areas here. But others have been strong just the whole time.
Yeah.
And it only seems to be getting better. And that's these areas like Phoenix.
San Francisco is definitely the outlier in terms of
that is the lone out for sure. And I almost, I've heard that San Jose mentioned a little bit in the same breath, but it is, that area, San Francisco, is not doing
really depressed. And just for the folks on listening via podcast and don't have not watching on YouTube, if you are watching on you're listening on a podcast, subscribe to the YouTube channel so you can get the full video. But also get us on a podcast so you can just listen to this in the car. But they've really broken this down to kind of 4 different kind of bubbles: recovery in progress, sustained momentum, strong demand through the pandemic, and leading recovery after the initial shock. And so, but also you can find this report on grayreport.com if you want to go take a look at it for yourself. So really fascinating, Matt. Appreciate you walking us through that.
Yeah.
Any other thoughts on the report?
Yeah, no, I just like this chart too, because it measures the vacancy change from 2020 to 2022, as well as the rent growth. And that's where they're really correlating all these strong markets that have high rent growth and really, and kind of growing vacancies, versus the ones that are really doing poorly with less vacancies with greater vacancies and lower rent growth. So it's a really nice illustration that, again, you can just see these groups that were implicit in other sets of data. They're really made explicit in this map here. Now, the next page is
tell us about this list,
where they really kind of start to put it on the line here, and they list they kind of rank what they think the top performing markets are going to be this next year. Orlando is at number 1. Now, if you scroll back up really quickly,
so is this the report? Because we were giving John Chang, who can put this report together, we were giving him a little bit of crap, because I think Indy is at the bottom of the list, and a lot of that is because of the downtown urban core. Now, it's obviously it's on the list, but obviously, they really like the Sunbelt markets, especially Dallas and others.
And I have some words about Indianapolis too in a second. And I think, but it is interesting. I think Orlando it's a leading recovery after an initial shock. So that's this kind of story of the market. And
think about, if the virus subsides, what is everyone going to do?
Exactly.
They're going to travel. They're going to frickin' Disney World with their kids.
I am going to Disney World this spring break, and
bam.
I know it's going to be
crowded.
Have fun. Okay. But yes, so Orlando is doing great. I don't see Indianapolis. It's not at the bottom. It is firmly in the middle of the pack. And what I think is almost a little bit more interesting about this list is that Indianapolis is the first of any Midwestern city.
Yeah. So if you're going to the Midwest, you're looking for yield, because sure, you can go to Las Vegas, you can go to you can go to Fort Lauderdale, which is number 3, but you're going to be paying. I just heard someone was paying a 2.5% cap rate. For dealing Fort Lauderdale. Same thing with Phoenix, West Palm, Orlando, or Las Vegas. I'm not as familiar with the cap rates in Orlando. I assume that they're quite low, especially when someone reads this report. So if you're looking for yield, if you go to the first market where you're going to get some yield, some good returns, that is a steady, sustained growth, which where they put it in, it kind of is at the top of the list. Yeah, and
you can look at the story of it versus of stability, and it certainly seems a whole lot less risky than some of these ones that are actively recovering after slumping down. And there's that implication. Well, is this volatility going to remain afterwards?
Yeah, 100%.
Another place, and I want to skip ahead here. It talks a lot of it delves in detail into the economic things that economic trends that we talked about a little bit earlier. But on this page here, we see the migration patterns associated with the rent growth. It is this, and then the next page where we can really see the difference at a glance at how the migration patterns. A lot of people seem to be moving to places like Miami and Florida. In the Sun Belt, you can see these markets like Salt Lake City, Las Vegas, Phoenix, and then these Texas markets as well. There's a big group of people that are all moving to the Sun Belt, and that can be seen in the rent growth of those areas as well. Top markets for population growth is Austin and Las Vegas and Phoenix, and those are both very high on, those are the ones that people are expecting. Now, nationally, they expect rent growth to be 5.2%, a little bit on the low end, considering Yardi Matrix and Apartment List and CoStar. Their projections seem to be about the 7% range, maybe. But I think 5% is a really nice number, and it's worth remembering that it wasn't always 5%. It was very much closer to 2 or 3 historically. So it's still going to be a really good year for that as well.
Yeah, it'll be interesting. And then also just curious, if we do see continued inflation more than what is predicted, how that affects rent growth. Now, obviously, there's some conversation of, is it tail wagging the dog, and is it really rent growth causing inflation or inflation causing rent growth? And there's a lot of other inputs, and I think there's probably a little bit of both. But certainly we see wages continue to rise, input costs going up, the producer price index is up, which is they're making stuff for future goods. I think we're talking about that later also. It's, can that lead to even further growth outside of that 5 to 7% range?
Yeah,
we'll see.
That's one of the things that I thought was a little bit interesting, is that there seems to be a whole lot of momentum that's represented in these charts. We were looking at places like Boise to kind of slope downward a little bit because they had such rapid rent growth during the pandemic. Maybe there's a peak, but it seems like these now Boise isn't represented specifically, but Idaho is in this map as a place where there's a lot of population growth that may continue their rent growth momentum. But other places that were extremely popular at the top of rent growth lists, like Salt Lake City, that continues to do really well, and they continue to expect it above 7% rent growth.
I think there's some interesting opportunities in some of those Mountain West markets. Interesting point that John Chang made last night during dinner was, we were talking about Boise, and he said, his big issue with Boise is just the liquidity. It's too small of a market, and you may have an issue on your exit. And so it's really, and he doesn't really have a dog in the fight. It's just, obviously the rent growth and population growth metrics are hitting on all cylinders, but there's different levels, different types of risk in going through some of those smaller markets. I think that if you understand the markets, you can have adequate liquidity to mitigate that. But it's nothing compared to, obviously, like a big primary gateway market. But just, it was an interesting point that he made about liquidity in the Boise market, which is top of the lists.
And I think another thing, and I want to use this slightly as a little bit of a transition, is supply, and that's highlighted by the next couple sources that I'd like to cover. One of which is this Berkadia report, and it's set up similarly to Marcus and Millichap. They don't have as extensive of an overview of the economy and the different trends in the capital markets and the apartment market, but they do have a nice summary of the supply that is coming in, the inventory growth, balanced with the rent growth on the next page. So I want to look at the inventory growth first here and note a couple of things. Now, Phoenix is at the top for rent growth, and we can see that on the next page. But Phoenix is at the top of rent growth at 15.6%, and they're adding 5.8% to their inventory. Still one of the top markets in terms of inventory, but that's a little less than half of the Huntsville growth that we're seeing. So Huntsville is adding 11.6% to their inventory for such a small market, relatively small. Now, it's still a very popular and competitive market in the Sun Belt. I think that is really a signal that area around Nashville, Knoxville, Chattanooga, Memphis, that kind of collection of markets is really doing spectacularly.
Yeah. Yep. I think that makes a lot of sense. And again, as we mentioned multiple times, we see other Midwest metros having more supply come online compared to Indianapolis. But Indianapolis has, really more growth than a lot of those markets.
Yeah. And so you look at this inventory growth, and I apologize for not being able to do a side-by-side comparison, but it is not exactly perfectly correlated with the rent growth in these regions. And I'll talk about this in the next article, but these builders, it's not an exact science. And sometimes there is a little bit of a gap between how much supply is coming in and how much rent is growing in a particular area. I think that looking at this map, the map of rent growth, looking at inventory growth, and then turning back to Marcus and Millichap and looking at how much migration is seen in any of these markets will really get you a long way to a really good forecast. I think it's really worthwhile. So I'm glad these came along the pipeline this week.
Absolutely. Matt, how about supply in 2022? I think RealPage had a good report. What's the story there?
Yeah, so this is not as deep of a dive as Marcus and Millichap's, with a little bit, or the Berkadia reports, but I think that there is really an interesting story developing around apartment supply in 2022. The market, Marcus and Millichap, shows that valid correlation, really, I think, between migration and apartment supply. But it's not an exact science, like I said, and there are plenty of reasons why builders may choose a specific market to build their next construction project. And apartment developers have a huge incentive to build where they're going to fill it up with renters. But in the rush to meet this demand and pursue the rising rents and competitive markets of 2021 and 2022, there's going to be a chance for overbuilding and too much supply. It's not going to be perfect. And I'm also not saying that the nearly 7% inventory increases in places like Nashville and Austin aren't going to be quickly absorbed by renters. But then when supply is overly concentrated in select markets and when demand is high really throughout the United States, there's going to be some big opportunities for investors who are watching the supply and really kind of figuring out how much inventory is going to change in select markets and where that's going to move the investment environment.
That's a good point, Matt. I mean, isn't the statistic that we've seen multiple times that about out of the 400,000 units expected to be built in 2022, a quarter of that will only be in 6 Sunbelt markets?
Yeah, and you can see the ones that are adding the most numbers are Phoenix, which is still also, it's just at the top of so many lists. There's a lot of migration. There's a lot of inventory coming in too. And in terms of sheer numbers alone, it's also adding so many. But you can see, Dallas is adding 17,000, Houston, Austin, Los Angeles, Phoenix, again, Atlanta. That's a lot. We maybe even on this list, you add them up and you get to at least 100,000. And they're all in those sunny southern markets. It's
you get over there pretty quickly. Yeah. Fascinating.
And that's what I wanted to say is that these high supply markets to watch really do include Austin and Nashville, along with that familiar leader Phoenix, which again is adding the most in terms of sheer numbers, and it's up there when it comes to the percentage as well. So
Matt, I learned that John Chang lives in Phoenix. Do you think that has anything to do with it?
I don't know. I think
he's got his thumb on the scale for Phoenix. Obviously, the numbers don't lie.
Yeah.
And again, he doesn't really have dog in the hunt. But right, Matt, RentCafe build to rent expected to hit all-time high in 2022. I was just in a meeting this morning talking about build to rent. We're looking for some build to rent opportunities, buying stabilized or just before stabilized assets. Again, I keep coming back to the fact that the American dream, I do not believe, is a 30-year fixed mortgage. I think an American dream is having a backyard for your kids and a dog dogs to play, and
Yeah.
space you can call your own.
Yeah.
And ownership doesn't really have anything to do with that. At the end of the day, I mean,
Yeah. Either you're
paying
paying the
property
bank or you're paying a
taxes, I mean, the government,
landlord.
so
Yeah.
exactly.
There's going to be a headache no matter if it comes in the form of a mortgage or a rent. There's a price for housing, and there is a value, an incredible value that's been placed on living in a specifically a detached home, but really like a single family rental as a market has exploded in the past year. If you look at the numbers from 6,000 to 13 to really like 14,000, it's more than doubled. There's a dramatic increase. And these are the ones that are under construction. So these are being built coming up for 2022.
That's great. Hopefully that gives us some opportunities to pick up some great communities.
Now, what is interesting too, though, there's 90,000 existing single family homes in the United States in nearly 720 communities designed specifically for renting. These 90,000 are much different than the amount of multifamily units there. So the market is smaller, but the amount of growth that we're seeing in it is definitely worth noting.
Yeah, and I think this is one of the areas where there is still maybe time to get in early, or at least that's how we're looking at it. And again, I'm looking at demographic shifts.
Mhm.
I'm looking at
Yeah.
millennials getting older, having kids, settling down. And then I'm also looking at baby boomers retiring, becoming empty nesters, selling that, 5,000 square foot home, simplifying, still getting a nice home, not living in an apartment, because a lot of them don't want to probably go to an apartment. Some do, for sure. But some, they still prefer a house. And again, the baby boomers and the millennials are just those large demographic cohorts. And where the bulk of the population is. And so if you can kind of just track what they're doing, where they're going, you can be pretty successful. The fact is, a lot of the millennials, they can't afford to buy homes, even if they want to. And some don't even want to anymore.
Yeah.
So I think that this is relatively early. I think we've got some legs on it. And again, that's why we're taking a hard look at build to rent opportunities in 2022 going forward. Again, 90,000, we're going to do more than 4 times of that in new construction and multifamily this year. And that's just the entire market.
Exactly.
That's pretty incredible.
And so that means maybe that it is a little bit easier to make that high jump, but still, as a sign of these shifting demographics, I think that your point is spot on. And it can also be seen that 61% of these single family rentals are in the suburban US, are in less densely populated areas. And there are also specific markets where there are more single family homes than others, which I think is a little bit different. And I'm not sure what it points to in terms of preferences, if there's maybe regional preferences or what. I think that Indianapolis is at or near the top, of the top 20 metros with the most single family units. Minneapolis is there too. There's more representation here in the Midwest. Columbus is the number 2 for the metros with the most single family rentals, which is, it's fairly noteworthy. You see a lot more distribution here than.
And I think part of that is, and this is really a negative for some of these markets, is that there is land. That there's plenty of land to build in Indiana. I mean, we've got still plenty of cornfields to expand into. There's really no limit on what we can build if we want to. And so there's a lot of single family homes in the suburbs. So that makes a lot of sense in some of these other markets.
New York, there's not a lot of space.
Yeah, I mean, look at that. I mean, if Indianapolis is above New York City, that's all you need to see. It's because why? There's no room. You can't build single family homes. You're going to be building higher density housing.
So a smaller market, but I think a really, really interesting opportunities that will continue. It seems like a lot of maybe short-term froth in the multifamily market, but there are some long-term prospects when it comes to single family rentals that are definitely, it's not just a 2022 forecast. I think that this is pointing to the future for the next 5 to 10 years.
Yeah, absolutely, Matt. All right. Great reports. And just to remind everyone, if you would like to receive these reports sent to your inbox every week, you hop on over to graycapitalllc.com/newsletter. You'll be able to sign up for the Gray Report newsletter. We're dropping these in your inbox again every Thursday, 8:30 Eastern. It's a very comprehensive report, and you will be able to stay up to date. But also subscribe to the Gray Capital YouTube channel so you can continue to watch this show every week as new episodes come out, clips, all that kinds of great stuff. But also, Matt, there's even a better resource that's on demand, and it's grayreport.com. It is the #1 multifamily intelligence aggregator. Again, we're taking all these reports as they come out, series of RSS feeds, automated technology, robots, artificial intelligence, and Matt, all putting this together on a daily basis.
Am I the robot or not? I don't know.
You're not no, we got the robots are in the back. But check out grayreport.com with a little header, which I think looks great, Matt. Nice work.
Oh, yeah.
All right.
Thank you.
All right. Okay. Inflation in 2022. You may have seen some videos we did last year at the beginning of 2021 saying that don't worry about capital gains taxes possibly being raised. Don't worry about, the Democrats potentially raising just taxes in general. The tax that we need to be paying attention to is inflation. And it's the invisible tax. It's eroding the purchasing power of Americans and really people all over the world. What happened? We've had the highest inflation rates in 40 years in 2021. To me, it was a relatively high probability that was going to happen for a multitude of factors. But now we're looking at the next year. And inflation, it's not as transitory as some would have thought. I still believe, even though it's like, I think we're going to see more inflation, I still think over time it is going to be relatively transitory. I don't think transitory is even the appropriate term because, again, we've talked about this. To me, transitory is a spike, is an amplitude spike, and it's a one event. It's not a prolonged period. And so, but we are in a prolonged period. I think we will revert back to normal slow growth. Again, getting back to these macro demographic changes and technology growth. But things are still cooking hot. We've got supply chain issues, Omicron concerns. Matt, what's new?
What I liked about this article, it's an opinion piece a few days ago from The Hill, and it covers the difference between the consumer price index and the producer price index. Consumer price index is at 7%, and which is the highest it's been since 1982. But the producer price index is significantly higher, and that is 9.7%. And there's a lot of ingredients that suggests that it will either persist or get a little worse on the producer side as well as the consumer side. The factors that they talk about here is a lot of it is commodity prices, core raw chemicals, the like aluminum, steel. There's you name your industry and it's feeling pressures really. Things like fertilizer ingredient potash is up 92%. Shipping costs are up 25% overall, which almost seems low considering the discussion that we've had about, we can't get anything on time.
Yeah.
All of this means that the costs of manufacturing have increased by more than 15%. And the farmer and that's it's not just manufacturing, construction's also up. Everything's up in a lot of different categories. I just think that it does seem overdetermined. And this is the real key quote that I liked. And I wanted to read out loud here. Doesn't this seem a lot more than the 9.7% rate the government reports for the producer price index?
Yeah.
It does because it is. It does because it is.
You can get... no surprise there. Whether we're talking about unemployment rate or tracking inflation, no surprise that the federal government's being careful of picking and choosing what they're counting. And when you see so many commodities and inputs, 25, 30, even double digits up. Yeah. That was the average in the single digit. But take it for what it's worth. But Matt, to me, this is just me, but I think really what the conclusion is, the CPI, current inflation, it's really a lagging indicator, very much a lagging indicator, where the PPI, it's a little bit more of a forward-looking indicator because these are inputs that are now being manufactured to goods that will be sold in the future, and which will then translate to higher CPI. Do I have that right?
Yeah, exactly. And he's saying that that this 9.7 for the PPI is even lower,
Yeah.
or is lower than it really should be. And I kind of tend to agree, considering all of these commodities pricing increases. Now, just because potash or potash, I'm not really sure how just because that one increase in 92%, that doesn't mean that farmers are paying 92% for everything. And so some of these commodities are just a small sliver of the costs of a company, but that's going to be passed on to the consumer. There's not really a whole lot of way out of that. They got to keep the lights on, and there's if the commodities, if the materials for producing something, especially including labor, go up, then things are going to go up. And what I thought was really worthwhile about this opinion article is that he doesn't even mention the enormous amount of cash washing around in the system thanks to the various stimulus and spending actions taken by Congress. It's not a political argument. Now he gets into it, but just alone, the individual increases in all of these commodities really seem to point to continued inflation.
Yeah. All right. So Matt, what do we do about it? What do we do about inflation? Harvard Business Review.
So I can just kind of fly through this. This is interesting from a company's perspective, and it really only further emphasizes that, like, you really don't have much you can do except for raise prices.
Could have bought real estate last year.
Exactly that, and what I think about in this case is there are ways to optimize and look at your best and most profitable areas, and we'll go into that in just a second. I guess historically the classic response is you can raise prices, you can upset your investors by cutting margins, or you can upset practically everyone by cutting corners. And it says, faced with this trilemma, most managers resort to raising their prices, and then they look for clever ways to mitigate the subsequent drama. And then, but their solution is, because we've got more data, we can move more nimbly now in 2022. It's a different story. And they say that instead of worrying about how much more to charge customers, they should devote their resources into figuring out how and why they should be charging them. That sounds a lot like mitigating drama of raised prices, but that's but
it makes it. I think if you tell the story, people understand. And I've had conversations. I was talking to in a smaller apartment owner. Well, really, I think it was mostly single family homes, and he's saying, I don't know how to tell. I've got these really great long term tenants at one of my properties, and they've been below market. I haven't raised rent on them for years, so I want them to stay. I'm worried that they're going to leave. I don't want them to leave.
Okay.
And they were saying that he's going to be going cash flow negative on the deal and on his property. And I'm like, well, if you explain to them, part of it was because his HOA was going up. I'm like, well, if you explain to them why your rent is rising, one, my expenses have gone up. I have to maintain the property. And two, you're paying, call it $1,000 per month. Market is at $2,000 per month. If you want to move out, you're going to be doubling. I'm not doubling your rent. I'm going to bump you up to $1,200.
Yeah.
$1,500, whatever, still a big discount. But if you don't explain that, then sure, people can get upset.
Yeah. Well, and that's and that's the frame of mind that I went into these opinions and these articles that are kind of taking the company's perspective on whether it's from producers and rising commodity prices or just rising rents and rising costs in general. The reason why prices have to raise aren't because CEOs want to keep their nice fat paycheck. I'm always kind of assuming that everything's even. There's going to be there's going to be differences on the margins, but really there are definitely situations where they have to keep wages high because there's a labor shortage, and so they have to keep that talent there. Otherwise, they can't keep the lights on. They can't have a business, period. And so they have to. The only option then is to raise prices. That's kind of where I'm at, is just if you kind of operating in a vacuum, if everything else was the same, if we're not pretending that it's greedy CEOs that are keeping their wages, really it's just things are more expensive and they got to charge them more.
Yeah, it's bottom line.
But yeah, these three options are, you can recalibrate, clean up the portfolio, focus on what's profitable. You can reposition the brand. Maybe you want to get into a higher price market, or you can replace the price model. And this is kind of getting what you said, being kind of communicative with your consumers, with renters, or really investors, to really kind of communicate what the value is and where it is and see the price in a different way. Whether that's, you know, they use the example of like a price per month or a price per mile or a price per unit of consumption that's much lower than a bundle of things that makes people realize, okay, this is actually what I'm buying. I think that people are aware that prices are going up, and it's incumbent upon businesses from investment companies to to candy bar retailers.
Well, you know what all I can think of, Matt, is there's going to be less chips in the bag.
Yeah, there will be some shrinkflation.
There's some shrinkflation. And you know what? I wish you would explain, like, look, we charge, we're charging $4 for the bag. If we charge $5, you don't want to pay $5. You want to, everyone wants to pay $4 for the bag of chips.
Well, and that's the thing too, is I think people appreciate transparency. They all know what's going on. They don't want you to just be upfront and raise the price. People don't want to be fooled because because they're receiving less for less money.
And communication transparency solves so many problems. I mean, I have conversations. People are like, how do you tackle investor relations? What do you do? And I'm like, well, we're just transparent. We just tell people what's going on. I make videos, so they're not just, we make a full report that's really detailed, and then I do a video report, and so they, there's a sense they're getting it from us directly. You can always reach out. Matt, this is a great episode of the Gray Report. I really appreciate you putting all of this, putting it all together as you do every week. Awesome job. Subscribe to the Gray Capital YouTube channel. Sign up for the Gray Report newsletter over at graycapitalllc.com/newsletter. And again, if you're ready to start taking a look at some multifamily investment opportunities specifically for the Gray Fund, which is the first fund that Gray Capital is launching in February 2022, only open to accredited investors. This isn't an offer to solicit or invest in anything. All the good legal disclaimer that you need to hear. Hop on over to graycapitalllc.com, schedule a meeting with one of our great investment associates, and we'll get started having a conversation, see if it's a good fit. Matt, thanks again. Sorry I have to run. I'm at NMHC meetings. Got to go.
It's fine. Another exciting day.
Exactly. All right. Have a good one. Stay warm there in Indy.